Welcome to the Radio Revenue Podcast.
Thanks for having me back. It's always great to be here with you.
Yeah, and today we are doing a deep dive into a company that, is basically synonymous with your office desk drawer.
Right.
We were talking about 3M.
Oh, yeah, an absolute industrial titan.
Right. And I think for anyone listening, when you hear 3M, your brain just immediately goes to Post-it notes.
Or Scotch tape.
Exactly. Or maybe that yellow sponge on your kitchen sink right now. It all feels very familiar and, well, safe. But we got our hands on the 2025 annual report.
Form 10K.
Yeah, the 10K,
Yep.
filed just recently in February 2026. And let me tell you, reading this document, it reveals a company that is almost unrecognizable from that sticky note giant we all know. It really feels like they're undergoing this massive, just radical structural redesign.
That is a very fair assessment, honestly. If you look at the fiscal year ending December 31st, 2025, you are looking at what historians of the market might actually call a pivotal moment.
Yeah.
Because this 10K, it isn't just a regular status update. It describes a company that is actively trying to shed its skin. They are shedding the past, specifically all those legacy legal liabilities in chemical manufacturing, just to define a completely new future.
It really feels like 2025 was the year of exit and separation. I mean, they aren't just selling things. They are stopping the sale of massive chemical lines, and they are spinning off huge chunks of the company.
Right.
It's like watching a skyscraper undergo a total structural renovation, but people are still working at their desks inside it.
That is a great analogy. You have all the noise of construction, the lawsuits, the spin-offs, while the office workers on the other floors are still just trying to sell adhesives and safety masks.
So our mission for this deep dive is to figure out if this slimmer 3M is actually stronger, or if the weight of all this litigation and restructuring is just still too heavy for the foundation to hold.
It's the billion-dollar question, literally. Is the surgery successful, or is the patient still in critical condition?
Okay, let's unpack this. The biggest headline, the thing that physically changed the shape of the company the most, was the spinoff.
The great split, as a lot of analysts are calling it now.
Right. And this happened back on April 1st, 2024. 3M took their healthcare business, which, by the way, was a huge revenue driver, and they spun it off into a standalone company called Solventum.
Correct. And we really need to look at the mechanics of this because it is detailed right there in the source material. 3M didn't just sell the division to a competitor.
Right. They didn't just hand it over for cash.
No, they distributed 80.1% of Solventum shares directly to 3M stockholders. So overnight, if you held 3M stock, you suddenly had shares in this brand new entity. And importantly, Solventum is no longer consolidated in 3M's financials. It's out.
But not completely out, right? Because reading through the notes, it seems like 3M just couldn't quite let go of everything. There's still a tether.
It's a nuanced exit, yes. 3M retained a stake of roughly 19.9% initially. And by the end of 2025, they were holding about a 15% stake, which the report values at $2 billion.
$2 billion?
Yeah. And they actually sold a portion of that stake in August 2025 for $0.6 billion.
So wait, they spun it off to get rid of it, but they kept a chunk. Is that just to have a rainy day fund?
In a way, yeah. It's a monetizable asset on their balance sheet. If they need cash, they can just sell more shares. But this split brings up a really fascinating concept mentioned in the report called Dyssynergies.
Dyssynergies. That sounds like classic corporate speak for we lost money.
It is exactly that, but specific to the mechanics of splitting up. When you are a massive conglomerate like the old 3M, you have incredible scale.
Right.
You have one HR department, one IT infrastructure, one supply chain team for everything from bandages to grinding wheels. When you rip a quarter of the company out the healthcare part, you lose that scale advantage.
So the overhead costs don't shrink as fast as the revenue does.
Exactly. You end up with stranded costs. That's overhead that used to support the healthcare business that 3M now just has to absorb or cut. The report highlights this as a definite drag on efficiency in the short term.
So they're smaller, and per unit, they're slightly more expensive to run. What do they get in return for that pain? Like, why even do it?
The argument is focus. They are now a company of 3 clear segments: safety and industrial, transportation and electronics, and consumer, instead of 4. They're trying to be leaner and more directed, but financially, it created a lot of noise.
Yeah, the stock charts looked crazy.
The report notes significant volatility in their earnings per share, their EPS, specifically because of the change in value of Solventum ownership.
Because the stock price of Solventum goes up and down, and since 3M still owns 15%, Their books look like a roller coaster.
Right. It's a special item that swung the numbers wildly in 2024 and 2025. If you are an investor reading this 10K, you have to mentally filter that out to see the real operating performance.
Okay, so that is the separation part. That's the limb they cut off. Now let's talk about the exit, because this is the part that I think affects the actual operations the most, and frankly, it is the most controversial topic surrounding the company. We are talking about PFAS.
The forever chemicals, per and polyfluoroalkyl substances.
Exactly. These are the chemicals that make things water resistant and heat resistant, but they also famously just never break down. 3M has been under immense pressure regarding these for years, and the 10K makes a very bold statement. It confirms that 3M completed its exit of PFAS manufacturing by the end of 2025.
That is a massive operational shift. I really think it's hard to overstate the complexity of that sentence. We aren't just talking about changing a formula for a glue stick here.
No.
We are talking about shutting down massive chemical reactors and production lines that have run for decades. It is a total industrial unwind.
And the report is transparent about the cost of this conscience, right?
Absolutely. It wasn't free. Look at the transportation and electronics segment in the report. Sales there were down 1.3%. The report explicitly says this was partly because they stopped selling these manufactured PFAS products. It was a self-inflicted headwind to growth.
Wow.
They voluntarily turned off a revenue tap to stop the liability from growing.
But they had to, right? Because of all the regulations and the lawsuits.
It was a strategic decision to mitigate risk, yes. But here is the challenge that the source material highlights. It is not easy to just replace these things. You have to ask, what products need these chemicals? It's high-tech stuff. We are talking lithium-ion batteries, printed circuit boards, seals for high-performance engines.
Wait, so my laptop battery or my car engine might have had 3M PFAS in it?
Highly likely, yes.
Yeah.
These chemicals were used because they work incredibly well under stress, and 3M is working to discontinue PFAS use across its entire portfolio, not just the raw manufacturing. But the report admits some transitions weren't finished by year-end 2025.
Why is it that hard to find a substitute?
It is incredibly difficult to find a substitute that handles heat and chemical resistance the way PFAS did without compromising the safety or performance of the battery or the circuit board. The report notes they are working with customers to transition, but it is a slow, painful engineering process.
Here is where it gets really interesting. The sheer scale of the cleanup. Because we aren't just talking about stopping production. We are talking about paying for the mess left behind.
The billion-dollar settlements. This is the section of the report labeled legal proceedings, and usually, in a standard company, this section is a paragraph or two.
Yeah, just some standard boilerplate.
Exactly. For 3M in 2025, it is the dominant financial story.
Let's run the numbers because they are just staggering.
Yeah.
First, the public water suppliers.
This is the PWS settlement. This addresses the contamination of drinking water systems across the United States. 3M agreed to pay between $10.5 billion and $12.5 billion.
That is billion with a B. And that is just to help water companies filter this stuff out.
Correct. And those payments started in 2024, and they are scheduled to run all the way through 2036. It is essentially a mortgage on the company for the next decade.
And that's just the water. What about the earplugs?
I feel like I saw ads for that lawsuit everywhere a few years ago. You know, did you use 3M earplugs in the military? The Combat Arms Earplugs, or CAE. This involved the dual-ended combat arms earplugs used by the U.S. military. They reached a settlement in August 2023. That one is €6 billion total, paid out between 2023 and 2029.
So roughly $18 billion in total settlements when you add it all up.
Yeah.
That is to crush their bank account.
It certainly drains it. If you look at the balance sheet in the report, cash and cash equivalents dropped from $5.6 billion in 2024 to $5.2 billion in 2025.
Only a slight drop, really.
But that small drop hides the volume of cash moving through the door, because the primary driver of cash usage, they paid out $3.4 billion in cash just in 2025 for these environmental liabilities and legal settlements.
They wrote a check for $3.4 billion in 1 year. That is staggering. Most companies don't even have that kind of revenue, let alone that kind of spare cash to just pay fines.
If we connect this to the bigger picture, though, there is a silver lining. And I know it sounds strange to call an $18 billion bill a silver lining.
Yeah, I'm really struggling to see a silver lining in losing $3.4 billion in cash, honestly.
The silver lining is certainty. For years, investors and analysts looked at 3M and saw unknown liability. Was it going to be $10 billion, $50 billion, $100 billion? Would it just bankrupt the company? Now the liability is quantified.
But it's a known quantity.
Exactly. It's a number on a spreadsheet with a payment schedule. Markets hate uncertainty more than they hate bad news. 3M has converted an existential threat into a monthly bill.
That is a really cynical but completely accurate way to put it. They bought certainty. They bought survival.
Okay, so setting aside the massive lawsuits and the spin-offs and the chemical shutdowns, did they actually sell anything in 2025? Like, is the actual business of making tape and sandpaper working?
Surprisingly, yes. Despite all the noise, the core machine is still running. Net sales were $24.9 billion, which is actually up 1.5%.
Up 1.5%. That is not exactly rocket ship growth,
Yeah.
but considering they turned off the PFAS tap, which reduced sales, it is something. Who did the heavy lifting there?
The safety and industrial segment. This is the biggest part of the company now. Sales were up 3.9% to $11.4 billion. What are they selling there? Is this just more tape?
It's the industrial backbone. Electrical markets, industrial adhesives, literally the glue holding cars and airplanes together, and personal safety gear.
Yeah.
This is the absolute bedrock of 3M. However, it wasn't all good news in that segment. Roofing granules and the automotive aftermarket were down.
Roofing granules. I always forget 3M makes the stuff on shingles.
It's a huge business for them. When housing slows down or people stop re-roofing their homes, 3M feels it. But let's look at the second segment, transportation and electronics. Sales were down 1.3% to $8.3 billion.
That is the PFAS impact we talked about earlier.
Exactly. That segment took the brunt of the exit. But also advanced materials struggled. The bright spot there was commercial branding and transportation. Think of those reflective signs on the highway or the wrap on a delivery truck. That actually saw organic growth.
And then there's the stuff I buy, the consumer segment. The stuff at Target and Walmart.
This was the weakest link in 2025. Sales were essentially flat, down slightly by 0.2% to $4.9 billion.
Why? Are people not buying Post-its anymore?
The report calls out consumer discretionary softness. That is the polite way of saying inflation hit people's wallets. People just aren't spending as much on packaging and expression, which is fancy talk for stationery and tape or home improvement.
Yeah, inflation hits the stationery budget first, I guess. If eggs are expensive, you just buy the generic tape.
Exactly. However, home and auto care and consumer safety grew, so people are still cleaning their cars and buying bandages. They just aren't redecorating or crafting as much.
So what does this all mean for where the money is coming from? Is 3M still an American powerhouse, or is it totally global now?
It is very much global, but the U.S. remains the absolute core. The report highlights that 54.5% of sales are from the Americas. Asia-Pacific grew 2.4%, but a lot of that was just currency translation, the math of converting foreign money back to dollars.
So the growth in Asia was mostly just exchange rates working in their favor.
A significant part of it, yes. The pure volume growth wasn't as strong as the headline number suggests.
And looking at the workforce, I noticed the headcount dropped.
It did. 60,500 employees as of December 31st, 2025. That is down from 61,500 the year prior.
1,000 jobs gone.
And that links back to the transformation program they began in 2025. They spent $51 million on restructuring costs. The goal was to streamline the supply chain and reduce management layers. They are trying to get flatter and faster.
But, and this is key, they aren't just cutting, they are still feeding the engine.
Yes. This is crucial for anyone wondering if 3M is dying or just evolving. They spent $1.17 billion on research and development. That is 4.7% of their sales.
Wow.
Even while paying out billions in lawsuits, they are pouring over $1 billion into the labs to invent the next big thing.
That seems like a really important signal. They aren't just cutting costs to survive. They're trying to innovate their way out of this transition.
Precisely. You cannot cut your way to growth in the long term. You have to invent.
Which brings us to the future. We know about the lawsuits. We know about the restructuring. What are the risks? Like, what keeps management up at night, according to this report?
Item 1A, risk factors. It is a laundry list of anxiety. First, raw materials. Inflation and supply constraints are still biting. Second, the global economy. Tariffs, geopolitical conflicts, and protectionism. 3M sells everywhere, so trade wars hurt them deeply.
And I saw something about cybersecurity that seemed really specific.
Yes, and this is very specific. The report explicitly mentions the phased implementation of a global ERP system.
Enterprise resource planning, the nervous system of a company.
Exactly. Moving a company the size of 3M to a new digital brain is incredibly risky. If that system goes down or gets hacked during the transition, factories stop, trucks stop, invoices don't go out. They list it as a major risk point for disruption.
Now, you found a nugget in this report that genuinely surprised me. Usually when we talk about legacy industrial companies with huge legal bills, we talk about their pension problems. We just assume they have raided the piggy bank to pay for things.
This is fascinating. You would expect, with all these cash payouts for lawsuits, that the pension would be underfunded. But the report says the U.S. pension plan is 94% funded, and the international plans, they are 124% funded.
124% funded. They have more money than they need for the retirees.
In the international plans, yes, that is a sign of incredible financial discipline over the years. Despite the legal payouts, they haven't raided the retirement chest. It is a sign of underlying financial health that often gets overlooked in the headline chaos. It tells you that the operational management is actually quite sound.
And speaking of financial discipline, or maybe generosity to shareholders, they are still buying back stock. This part confused me.
It confuses a lot of people. Despite the cash drain from the PWS and earplug lawsuits, they bought back $3.3 billion of their own stock in 2025.
Wait, let me get this straight. They paid $3.4 billion in lawsuit settlements and $3.3 billion in stock buybacks.
Almost dollar for dollar.
Why? Why not save that $3.3 billion to pay off the lawsuits faster?
It sends a very strong message to Wall Street. It says, we can handle the lawsuits and still return cash to you. It projects confidence. If they stop the buybacks, the market might panic and think the lawsuits are drowning them. By doing both, they are flexing their muscles.
That is a high-stakes poker game. Look how rich we are, we can pay our fines and still buy our own stock.
Whether that is sustainable in the long run is the big question. But for 2025, they pulled it off.
So let's wrap this up. We have a giant that successfully cut off a limb, Solventum, and stopped a major chemical production line, PFAS.
And yet, they still managed to grow sales by 1.5%.
It feels like they're walking a tightrope.
The new 3M is definitely smaller. It is burdened by these long-term payment plans for past issues. But the core business, making things stick, grind, and protect, it remains highly profitable. The operating margins are around 18.6%.
That's solid.
That is a healthy business. The uncertainty that plagued the stock for years is fading, replaced by a simple payment schedule.
It's like they have finally cleaned out the basement. It was expensive, and it took a lot of work, but now they can just focus on maintaining the house.
I would leave you with this provocative thought. 3M has spent billions to clean up its past. They have successfully walled off the liability. The question for 2026 is, can their R&D engine invent a future that is profitable enough to pay for it?
That is the billion-dollar question. Can they invent the next Post-it note while paying off the mortgage on the last crisis?
Only time will tell.
This is Revenue Radio Podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.